Okay, let's move on and let's talk about some of the other stocks which are going to be in focus. We already highlighted what Gland Pharma has done. A revenue decline of 12%, EBITDA down 17%, and margins coming in at 30.9 versus a comparable of 33 in the previous quarter. So that's definitely going to be one stock to look out for. Although in the last 3 months already, there's been quite a bit of depreciation that we've seen in the stock price, which has fallen over 38%. Chakri, is pharma an avoid right now, or would you still be selective?
I think still it's the names like Sun Pharma, Lupin, for that limited activity in the sector. Otherwise, each individual company still has a lot of its own issues, and so therefore, all those issues which kind of went silent during the COVID period have come back, and therefore, as a sector, it is more of cherry picking. So I'd still stick with just Sun and Lupin at this point.
So what are your top 3 holdings, Chakri? Tell us a bit more about it.
Our top 3 holdings are still banks. It is SBI, Bank of India, as well as Canara Bank. So all 3 are banks, and because for all the reasons that we just discussed, I think valuations are clearly on their side. The banks are far better than they were. Their ROAs are improving, and second, now they have a business catalyst in terms of infrastructure spend, which usually the borrowing happens from PSU banks.
All right, let's just take stock then of the pre-open rates as well this morning. Just about kick-starting on your screens around the 18,200 mark. That's up 0.5%. And for the Sensex settling around 60,900. Let's find out those mid-cap trading calls as well from our experts. And Naresh, what is it that's catching your eye within the broader universe?
So that would be a buy on Birlasoft. The stock is corrected from the top almost 50%, from 580 all the way down to 270. Then made a recovery to 340, then again dipped back and now was in a sideways range of 285 to 300. Yesterday the stock crossed about the 300 mark, a short-term breakout. I would expect it to again go back to 330, 340 in the extreme short term. So it's a trade for the next few sessions, a stop loss at 295 and a target price of 330.
Okay, so Birlasoft on Naresh's list. Manoj, coming to you, what ideas have you brought for our viewers, stock specific from the broader markets?
Now, there is an interesting idea. I believe that this is for the first time since October. IT as a sector is seeing good rollover and positioning the cash market. So I guess, as I was saying, in the October series, obviously because of the relevance it has to Nasdaq's, the cherry picking was not really much. But then the institution is always been selecting, and they have been buying in the cash market. But as of now, at least for the short term, emphasis would be a good buy because we have seen good long build up in yesterday's trade, and we are expecting the stock to rally all the way to 2120 to 2130 as a target. 2061 is where you can buy that. The stop loss should be close to 2010 on the stock.
Right, Manoj, we'll let you go on that note. Thanks as always for taking the time out. Let's just switch focus while the SGX Nifty Sure is indicating a positive start for us. Let's just see what the pre-open rates as well are indicating, while the rupee has strengthened all the way to that 81.55 to the greenback. Just very, very quiet once again. So nothing different. We've been used to a very, very flat start, and flat it is right now too for the indexes. But here's what else is making headlines. And Microsoft announced a new multi-year, multi-billion-dollar investment with ChatGPT maker OpenAI. Microsoft declined to provide a specific dollar amount, but media reports have pegged it at $10 billion. The deal marks the third phase of the partnership between the two companies, and Microsoft's investment will help the companies create new AI-powered backed experiences. Also, Spotify announced that it's cutting 6% of its global workforce. The music streaming company has contended with the gloomy economic environment that has seen consumers and advertisers limit their spending. The cuts will impact about 600 employees. They also sent out an internal memo to staff announcing the layoffs. Also, Ford Motor plans to cut about 3,200 jobs across Europe and move some product development work to the United States. The company wants to axe up to 2,500 jobs in product development and up to 700 in administrative roles, with the German locations mostly affected.
Meantime, Google CEO Sundar Pichai told employees that the job cuts were made in a bid to act decisively as the company's growth has slowed down. In an internal meeting, Pichai said that he consulted with the company's founders and board making the decision for those 6% cuts. Meantime, Apple is looking to manufacture 25% of its iPhones in India, according to the country's Commerce Minister. Piyush Goyal called Apple another success story for India. Just last year, Apple began assembling its flagship iPhone 14 in India and has been looking to diversify production away from China, where it currently makes a bulk of its iPhones. And Tata Motors announced that it will delist from the New York Stock Exchange from Monday. There will be no over-the-counter market trading of the American depository shares in the United States due to regulatory restrictions under the Indian law. Remember, in November last year, Tata Motors said it does plan to voluntarily delist the ADRs. All right, let's get a move on then and find out what exactly is going to be the budget cover. Is the finance minister going to axe the tax, or is there going to be any tinkering or any increases? And that is going to be on everyone's mind on the 1st of February. In particular, what is going to be the personal income tax slabs. Sources are telling your channel that this time around, the government may raise the income tax exemption limits, which could mean higher IT exemption limit on old slabs as well. Let's take it across to my colleague Prakash, who joins in. Prakash, what exactly are your sources indicating as to what the finance minister could do?
Yes, taxpayers may get relief from the union budget, which is going to be tabled on February 1st, 2023. Sources are informing that the government may announce some changes in new tax slab structure. The changes could be made to encourage taxpayers to adopt new tax slab structure going forward. As you are aware that under new tax slab structure, taxpayers may get relief in income tax rate without exemption. But as far as adoption rate is concerned, it is not as high as it was anticipated by the government. So making it more attractive, government is now mulling to provide some relief under new tax slab structure. Sources are also informing that government may announce enhancement in exemption limit on income, which is rupees 2.5 lakhs now. Also, income up to 20 lakhs may be brought in under 20% tax structure under new regime. As you are aware that the industry have made their representation to the finance ministry during pre-budget consultation to provide much needed relief to the consumer, to increase consumption in the country. It may also help industry to grow further on back of increased consumption and demand. So taking all into consideration, government is now mulling to provide some relief in new tax structure, and that could be announced in the budget.
Okay, Prakash, so that's the budget cover being brought for all of our viewers today. Will she axe the tax? The chatter being that we could see a tinkering of the slabs and the exemption limit for the lower one of 2.5 lakhs being increased. Remember, this is the last full year budget before elections, before the general elections. Will it be a budget which will also be populist, however? All of that and more. Stay tuned to ET Now. We will be analyzing it live for you with the best of experts. Right, now let's get you some dealing room chatter, and this is to do with Citi, and actually a channel check that Citi did with investors in Singapore as far as its strategy for India goes. Long-term bullish on India. What are the bets? What are the opportunities of growth that are being seen? Let's go across to Pankaj Poddar, who's now joining us live with this. Good morning, Pankaj.
Well, what we're picking up as far as the deal buzz or the market buzz is concerned is that Citi went to Singapore and various other locations where there are a lot of FIIs, spoke to about 30 plus investors as far as Indian markets are concerned. Most of them are related to emerging market ideas. Now, they do it every, about 3 months or 6 months, and last when they did it was in the month of October 2022. So it's been about 4.5 months since they actually did it. Now, when they did it, there is a big sentiment change. Clearly, earlier, India was the TINA factor, which means India was the only market in the emerging markets that people want to go to. And now it's completely opposite. They're saying they are much better relative markets versus India. So that's definitely one change. However, long-term view continues to be positive. So any correction in the market, they would be looking in to buy the Indian markets. That's the buzz as far as that entire takeaway is concerned. Now, when you talk about sectors in banks, what will happen to NIMs? How will NIMs move forward? Will there be a NIM compression? That is something which the street is extremely worried about, and that were the key questions. As far as infrastructure is concerned, budget will be important. That's the key thing to watch out for. Will the positive trajectory on expenditure, specifically infrastructure and capex, continue or not, along with various other small schemes that they are promoting for manufacturing? So that's been the second key talking point. The third key talking point has been what's happening to mutual fund flows. Yes, it has been declining, definitely a positive number, but nevertheless, it has been declining. That is something which is, as far as a worry for global investors are concerned, that, if that actually comes down and they are also sellers, what essentially can happen to the Indian markets in the near term.
Thanks very much. That's the dealing room buzz from Pankaj. But let's also find out those index calls then. What is it that our chartists are advising when it comes to positions on the index? Well, apart from Manoj, who's got a buy recommendation, it seems to be tilting towards a hold call. Do remember those pre-open rates. And on the back of the fact that it has been a pretty steady handover from Wall Street, it's expected to be a decent start. We're in the expiry week as well. A hold recommendation, that's the consensus on the Nifty index. Banks sure are in the spotlight on the back of earnings reactions, and on the Nifty Bank, here's the call coming in from our chartists. A hold call from both Naresh as well as Kush. Manoj believes it's a buy, and that's the market moodometer. What's the call on the Nifty Bank index? Well, continues to remain a hold recommendation.
Bajaj Finance and NCC, those are two calls. One from Sanjeev Bhasin, other one is from Gaurang. SGX is indicating that we are in for an absolutely flat start. But with each passing day, I think we are now convincingly moving above 18,000. That scare of that 17,800 would be broken and we will just fall like a stone from there. I think for the moment it has got averted, and for a moment that has got arrested. But IT is where the comeback has been slightly stellar. A stock like HCL Tech from the 52-week low is up about 25-26%. It's been across the board double-digit gain for large cap IT stocks from the recent low. We are looking at that data. That's HCL Tech for you from the 52-week low, which happened, let's say, earlier in the second half of last year, 850, 860. The stock now is at 1125. That's the IT space for you. HCL Tech is up 30% from its 52-week low. TCS is up 16% from its 52-week low. Tech Mahindra is up only 13% from its 52-week low. So Naresh, can I say HCL Tech qualifies as the strongest stock, 28% up from the recent low?
Yeah, clearly the stock has been say, even in the short term as well as in the little medium term, the stock has finally started showing strength compared to the rest of the market. So in the IT pack, and also it did not correct as much. And in the previous move itself from September to say that move from September bottom itself, it had moved up from 900 to 1140. And one of the few stocks which is actually trying to cross that mark which was made in this bounce. So we are not very far away from 1150. So I would say in the large cap IT space, HCL Tech continues to be the strongest one.
Chakri, is HCL Tech the strongest one?
HCL Tech still has valuation clearly on its side, and they're one of the few companies in their announcements, earnings announcements, that their order book still continues to build at a fairly healthy space. HCL Tech always has had this thing of doing one quarter well, one quarter bad, but overall, the company's valuation is on its side, margins are improving. So I think clearly HCL we can buy at current levels.
Right. Okay, that's the take coming in on what is it that Chakri is liking. It's a long list of earnings that we're going to be reacting to this morning. And, like we flagged off, starting off, of course, with Axis Bank. You've got a whole host of other earnings as well. Mid-cap IT, of course, is one pocket that we're looking out for in terms of whether or not the rebound that one have seen in the IT names, is that here to stay, and whether that's going to continue or not. So that's also one space that we're looking out for. Today, of course, you've got Maruti, you've got HDFC AMC, United Spirits, Pidilite, Tata Coffee, Colgate, TVS Motors, and a plethora of other mid-cap earnings that we're going to be keeping on our radar. But just very quickly, top on our radar, of course, is going to be a reaction on Gland Pharma's disappointing numbers. Axis, like I pointed out, the dhamaka that Poonawalla FinCorp has posted this time. There's also Butterfly Gandhimati as well, wherein the revenues have come in flat in the quarter gone by. There's Jindal Stainless, there's IIFL, there's KEI Industries. The order book is looking extremely robust, so that's another stock to look out for. Container Corp also came out with its numbers. Both the PAT as well as the revenues are sort of in line with what the street was anticipating. Triveni Turbine, Sagar Cements, Syngene, and yes, Tatacom, which has turned out to be a bit of a disappointment. The net profit has come in lower by 26%. The EBITDA margin also has seen a squeeze. It's come in at 23.8% versus a comparable of 25.5. Tatacom is the stock that I'm talking about. That's going to be the other one on our radar this morning. But for the trade setup, Nikunj, I think it looks like a no-go. It's a quiet start once again.
Yeah, I mean, I think it'll remain like this. Remember, there is a holiday on Thursday, so the expiry happens tomorrow. But we are just not latching on to the global strength, and that is, I think, evident. Now, Indian markets did exceptionally well last year. Others fell and we held out. But now we are not participating and other markets are catching up. Which in a sense is also good news. Why? Because the gap between other markets and us now gets narrowed. So, another 4-5% here, another 4-5% up for other emerging markets, and then suddenly Indian market outperformance will not look all that stark. First rates Tuesday morning, it's a truncated week, but it's a flat start for the markets. Nifty 60 points higher, Bank Nifty absolutely flat. The market breadth, nothing very meaningful. These are initial rates, they will change. I mean, the market breadth of late has been quite tepid. For the moment, just to put it on record, all major indices are off to a flat start. 0.5%, 0.25%, that kind of a gap up start I think is there, which frankly is meaningless to understand the trend. I'll tell you what's trending. What's trending on my screen is Jammu Kashmir Bank. It's up, and it's up from the word go. Up 5.5% for Jammu Kashmir Bank. Then you want to mark Yes Bank after that entire A1 bondholder verdict. The stock yesterday collapsed, lost about 10% plus. Today that one seems to be bouncing back. You got Poonawalla FinCorp, which came out with good set of numbers. Of course, there's a different, it's become a different entity now after the acquisition by the Poonawalla group, and that in a sense is now, this business is now growing because of the support what they're getting from the balance sheet of the other group companies. Axis Bank, I think numbers were perfectly fine, but we are in that phase of the market where good news is getting ignored, bad news is getting punished. So if Axis Bank is down, what about Tatacom and Gland Pharma? Let's look at both those stocks, because bad news is getting ruthlessly punished. There you go, 1344 for Tatacom, 40 rupees down there. And then Gland Pharma, again thought as much, 3.5% down. So good news, no one cares. Bad news, hammer the stock down. That's the kind of mindset I think the markets currently are in.
Just a couple of exceptions there. J&K Bank, Nikunj was flagging off. The profits have come up 79%, and the NII has also seen a recovery of 27% on a year-on-year basis. There's of course Shoppers Stop as well, their highest ever quarterly sales and EBITDA in the third quarter. That's what they've clocked, about 1.5% higher for Shoppers Stop. Supreme Petro came out with its numbers. The net profit, the EBITDA is up more than 45%. Dilip Buildcon and its subsidiary has once again turned out to be the lowest bidder for a project worth about 1,947 crore rupees. Numbers coming in from Satin Credit, higher by 75%. The profits that is, and NII has come in higher by 38%. KEI Industries as well, the profit is up a good 26%, seems like a beat. So KEI as well as the other stock to look out for. On the flip side, Maruti, they've recalled 11,000 Grand Vitara cars. There's also Concord, wherein the EBITDA is down 7% on a sequential basis. Gland Pharma, it's a gap down, yes. Syngene came out with its numbers. Revenue, profit have all managed to miss the street estimates. Syngene lower, marginally or so. Sagar Cements, again, a loss of 27 crore rupees. And Zensa Technologies, wherein the constant currency revenue is down nearly about 5.5%. Okay, let me take it across to Naresh then and get in the first trades this morning. Naresh, A quiet start for the index, but any trading ideas that you've identified?
So that would be a buy on NTPC. Now, this is a preemptive one. The stock has a breakout above 171, but buying at current levels where the risk reward becomes interesting. And the fact that it is the largest weight in the Nifty PSE index, which is trying to give a big long-term breakout about last many years of highs. So I would go with NTPC, which is the best placed in the PSE basket. So continue to like the stock, will add more about 170, 71.
Ajay Srivastava joins us. Let's say hello and good morning to him. Good morning. Thank you for joining us. It's a very bright tie. At least sun is shining somewhere.
Listen, life is good. No complaints. So what else do you want in life, right? Early January is which passed us, and there has been no mishap in the market. What else do you want to?
Well, you own commodity stocks, so I'm sure it's been a good year for you.
Well, it's been nice. As I said, God is kind, and you keep your fingers crossed. Don't be greedy, and life looks after you.
But why are we not latching on to the global narrative? Flows are moving against us. Other emerging markets are coming back. Nasdaq has rallied, and Indian markets, which in a sense they had the biggest promise at the start of the year, suddenly, despite that promise, are lagging. They are lagging the global markets, and the underperformance now is very obvious.
Well, it depends upon what time frame you take, because the fact is we have overperformed over the last 12 to 18 months, and therefore, while the other markets were cranking down dramatically, we were holding steady. And I would, in fact, say that our markets have been more resilient than we ever thought of. In fact, the joke in our office is that for the Bravery Award, we should go to the Indian investor, because he has been climbing the SIP mountain against all kind of odds: higher interest rate, higher inflation, global slowdown, FPI is withdrawing money. But this man keeps climbing the mountain called FPI. So I would, in the reverse, argue the fact that we are amazed at the bravery of the Indian investor, that against all odds is putting its money where it doesn't expect to get a return. Now, that's sheer bravery of a kind which I've not seen in the financial market for a long time. So I would say 18,200, great market, great resilience given the fundamental of the economy and the growth rate. You cannot argue with the fact that the index holding at 18,000 plus itself is a miracle.
Yeah, it sure is. And especially given that we're just 8 days away from the budget. And Ajay, typically always when you approach closer to the budget, the chatter becomes louder on LTCG. Do you think there is a base case for rates to be neutralized as hinted by one of the ex-ministers?
Not at all. I don't think there is any case for, this is a banter for budget. Every year there's some banter because people need to talk about the budget. In fact, I'll share with you, this time I've decided to go on a trek on the budget day. I said, not even want to watch the budget and see, does it affect my life? So I'll be away actually not even watching the budget. But I don't think so there is any room for tax cut at this point of time. In an election year, that's absolutely wrong signaling going to give it out. They need to put up money for the poor. They need to put up money for all the kind of situation that we're seeing on the ground. The rural India is under pressure. Inflation has eaten up a lot of purchasing power. So I think there are many more competing uses for money than to give an LTCG cut at this point of time. We don't expect, and neither I'd hope it will not happen, there'll be any tax cut of any kind. I think you'll have more repackaging of schemes, more stuff happening there. But tax cut, forget it. I don't think so. It's even on the horizon.
Market's nervous. I mean, what you're indicating, I think it's perfect, which is that the importance of budget over the years has got diluted. Big reforms have already happened. With GST, this whole suspense of what is mehenga, what is sasta, that is out of the window. DTC, it's a commitment which government is following. So if the budget is going to be no-win from a market standpoint, and an investor like yours are looking at going for a trek, then why are markets so nervous because of this event?
Are they nervous? 18,200, 18,100, they are resilient at this point in time. Where is the nervousness in the market? Is that because it hasn't gone up over 18,200, which it should not have in the first place? So I don't see any nervousness in the market. The investors are staying put in the market. There's hardly any selling happening in the domestic front. May not be too much buying at this point of time, logically speaking. But where is the selling? Do you see any selling? Nobody is selling anything. Yes, there will be movement of money from equity to fixed income, given the returns have become much better. So that is bound to happen. But what we are seeing in the market is two things. One, the net surplus investing power of the public is gone down slightly. and that is showing up in the SIPs and other investments. But otherwise, in terms of pure investment play, people are holding on to the investment. May not be adding up, which is correct, good strategy, but certainly not liquidating their investment. So I don't see any nervousness. What I see is just the lack of excitement to buy more. That's all I see today in the market.
While we're talking about markets, let's talk about where you're headed for your trek.
Oh, down in the south and the western Ghats. I'm trying to find a king cobra. So let's see whether we find one or not.
Okay, interesting. Once you're done with your trek, you must stop by over Mumbai.
Oh, sure, absolutely. If I survive it, I shall do that.
Of course you will. But tell me, will markets survive whatever is going to come our way in the year ahead? Because, while relatively, like Nikunj was just highlighting, the outperformance is obviously much stark when it comes to some of the other emerging markets like Taiwan, US, even NASDAQ has recovered quite a fair bit. But do we now bid adieu to that outperformance that we sat on all through 2022?
It's by nature that markets which are corrected should recover first before India flies. So that will be the nature of the beast, will be that you'll find NASDAQ to come up somehow or the other before the world markets start to climb up. So I think at the end of the day, America will have to take the lead again and give us the leads into the next sector. India has a different challenge. I think India's challenge is going to become that the great uplift of profits thanks to high inflation, that's over. The great uplift of profits thanks to rupee depreciation for dollar companies like IT companies, that's going to be over this year. So, and number two, the growth rate is going to be marginal at 6%. So India's challenge is that the optical numbers of most companies would be less than flattering over the previous year when you go into 2023, because they will not get the benefit of the inflation, neither rupee depreciation. So, so in that environment, you will find subdued growth on the optical numbers on the side. The key factor would still remain that will the capital good industry take the market up? And I think that's the crucial question for India. Is capital good industry has done well, extremely well. Commodities have done well, extremely well. But will that performance continue? And I think that's the challenge in the market, that will the infrastructure story continue? Because the rest of the story cannot have a great legs, because at 6% growth rate, how much can consumption grow up? And, you'll have pockets like five-star hotels doing well, the luxury segment doing well, but that's such a small segment of India. That's not large India. But challenge is going to be, will capital goods continue their outperformance in the industry?
Good morning, Ajay. So while you go looking for King Cobra in the south, it's well documented that you are playing in the markets with a view that there will be political compulsions on the government to invest in the northeast, and that has been a reason for your infrastructure play, investment in tea, also if I'm not mistaken, real estate as well. Is that a theme that you still continue to go with, and will commodities remain your top pick this year?
Oh, absolutely. Absolutely. I think that if you travel on Northeast, you'll find that the government push is very visible. It's visible to everybody. The road which goes on to Burma and the infrastructure growth there, the traffic jams in Meghalaya. You could be sitting in a 2-hour traffic jam in the middle of Meghalaya. You wonder where all these people came from. But the fact remains, Northeast is a reality of growth, which is going to be exceedingly higher than India's growth. Real estate is cheap, of course. Tea gardens are dramatically cheap. That is visible to everybody, the good quality assets which are going around. So I think the Northeast will continue to be a great story. It's difficult to enter the market because it's like tea is not a great companies that you can invest in. You got to be careful where you invest your money, etc. Real estate is a different play altogether. And other infrastructure plays, you got to be localized to buy that story. But Northeast is a budding story in India, definitely. And India, if it has to grow, commodities will remain the story because it's monopoly. There's no new company can come up. We cannot afford large-scale import in this country. Sooner or later, the copper smelter will start in Chennai. We can't afford to be importing so much of copper in this country. And if you have to grow even 7, 8, 10%, and no major capacity is coming up, the existing commodity companies are going to make money on the play in any case. I find it the safest place where India's growth story will play out will be commodities. Because if commodities don't work, the rest of India's story will not come together. If it doesn't come together, hardly a case to buy a consumer company or any other company altogether. The only exception I can see now is that the banks who have given tremendous profit, and that worries me. It worries me to no end because bank profits are a cost to the industry and people. So the impoverishment of the whole of India resulting in profits of 8 banks, it's happened again after 6-7 years. And that to me is the biggest threat to the market and the companies is if RBI continues this policy of allowing banks to make supernormal profits in India, the rest of the industry and the retail consumption will suffer and suffer heavily. So that weight needs to be moved. We need to get the NIMs down to 2%. 4 is unheard of in the global market. So if RBI policy continues to favor the banks, consumption is going to suffer. And that's I think the biggest risk to the market is the higher NIMs of the bank versus the cost which people have to bear to pay those kind of interest rates.
Would you then take a contra bet against banks?
You don't never bet against the banks at the end of the day. And the reason you don't bet against private banks is that RBI has always sheltered them for everything possible in the world. Whenever they have a problem, RBI's policy changes and it's the only one to do it. So, you have a pretty sheltered regulatory sandbox, if one were to say so, for the private banks. They get best benefits, everybody. You don't bet against the bank. The question is, how much of allocation do you make to your portfolio in the bank? Will they outperform the rest of the market? On which we have a theory that it's very difficult for Indian banks to outperform the rest of the market in a longer period. Very, very difficult for them to do it. And, if it's Indian economy is going to grow 6%, I don't see this kind of growth coming in the banks at the end of the day. So therefore, I would not bet against the banks, but I would certainly be reasonable in my allocation to the portfolio, not go overboard as sometimes we do with the banks and say fantastic profits. I think the best profitability season of the bank perhaps is over or will be over by March 31st. Thereafter, you'll have a problem in terms of maintaining the growth rate because inflation is dying down to 5%, it's no more 10%. So optical loan values itself will start to come down or growth will start to come down, if not the quantum.
All right, Ajay, appreciate your time. So glad you could join us.
Thank you very much. You have a good time. Have a good budget.
Thank you very much. Tata Motors is the star today, 8 rupees higher. Finally, Tata Motors the stock today is reacting to all the news that there is going to be a subsidiary of Tata Motors which will go public in 2023. Economic Times reported last week that they're looking at getting another investor at a surplus, at a higher level in the EV business. 2 years ago, they got TPG. Now there could be somebody else which could come in at a higher level. That's what the Economic Times reported. But I'm going to shift gears. Satyanarayan Raju, Executive Director with Canara Bank, joins us, and let's connect with him. Mr. Raju, good morning. Thank you for joining us. Now, first, the NIMs. They breached 3% this quarter. They look strong. But with deposit growth in focus now, how sustainable are 3% NIMs in the near term?
This current financial year, we are given a guidance of 2.90% for the NIM. For this 9 months period, we are already at 2.93. Particularly specifically for the third quarter, our NIM has crossed 3 and 3.05 as on December 31st. You look at that, our rate of interest, what we have paid is 7.7% and senior citizen 7.5%. That throughout the quarter, it has having a little impact on my NIM because simultaneously there is an increase on the yield on advances. Our yield on advances has increased more than 21 basis points. That is helping a lot on that. So our overall, our guidance for the NIM will be in and around of 3%.
Sure. But your recoveries, they continue to pretty, hold steady. The last we spoke, you had guided for about a 15,000 crore rupee recovery in FY23. Going forward, what kind of trend can one expect?
Generally, what we are telling for the last quarters, our guidance is whatever our slippages, our recovery should be more than that. Look at that the quarter 3 results also, our slippages are 3,048 crores. Whereas our cash recovery itself is at 3,080 crores. If we add our upgradation of 940 crores, the total reduction in the NPI is more than 4,000 crores. This tendency will continue in future also, but our more thrust will be on slippages. So that's why we are reworked on our underwriting standards on various RAM schemes and close monitoring on the SMA 0 itself instead of allowing them to a SMA 1 and SMA 2. Our even stress assets total overall above 5 crore, if you look at that, it is only a 0.74%. So that has given a cushion for us, and that the same tempo will continue. And our main focus will be on slippages. Slippages quarter on quarter, we want to show a better results, and automatically, simultaneously, our aim is to see that our cash recoveries are more than our slippages.
Now, we've heard commentary from the top 3 private sector banks, Mr. Raju, and it indicates that select corporate lending is seeing some mispricing. What is the risk profile like according to you, and are you seeing strong competition?
Being actually our strength is our fast decision. The corporate book, our corporate book has grown because of that, our fast decision in the maybe yes or no, that is helping us in that. But we are not compromising on the price. Price-wise, there is no compromise. That is the reason you can look at that. Though the last quarter, our growth in the corporate is comparatively higher than the RAM, our yield on advances still we have improved from 7.21 to 7.45.
Good morning, Mr. Raju. Now, if you were to look at your corporate loan book, you're of course also lending to infrastructure and NBFC. What's the risk appetite when it comes to this?
The infrastructure, we are lending to only HAM projects. In HAM projects, there are certain guidelines we have kept inside within the policy guidelines that whatever the margin it is to be contributed by the promoter, 50% of the margin should come from upfront, and our the lending should not be more than 50% of the total project cost, and it should be only the promoter company should be A and above rated companies, and we are also insisting personal guarantee in those things in addition to the corporate guarantee, and average yield on that also we are stipulated a minimum 8.5 to 9%. That is the average yield we are insisting on that. Actually the repayment is ensured directly from the NHAA. That's why we have taken an exposure in the HAM projects. Other than HAM projects, we are taking in generally the data centers are coming out. In there we are looking at little more. Otherwise, we are cautious on that infrastructure front. In somewhere, we have taken exposure in the even energy saving like solar energy and all. These are also we are focused more on A-rated companies. Look at our corporate lending, So that's our exposure is 78% of corporate lending is A and above rated, and triple B is on 12%, and the double B and below is only at 10%. There is a drastic reduction in the double B and B from the last 1 year. It was a 15%. Now it has come down to 10%. That cautious lending is there in the infrastructure. Regarding NBFC, the NBFC growth, it looks that we have grown well, but that majority of the growth, it has come from the central public sector enterprises. So even in NBFC, our exposure to the corporate is 98% is A and above rated, and the remaining is only 2%, madam.
Your provisions for 4,000, you have in your provisioning of 4,000 crore, you've guided for a credit cost of about 1.5%. Any specific amount which has issues in the quarter gone by, and how do we expect normalization there?
It's nothing. It's a routine. There is no specific account or a big account has slipped to NPA. Even the third quarter, not even a single corporate account has been slipped to NPA. Entire slippage, those 3,000 crores, it is from the RAM sector only. And in the current quarter also, we are not expecting a big slippage from a corporate.
Right. Your ROAs, though, are inching up. By FY24, can we expect the ROAs of, say, 1%?
The way we are growing from the last 1 year, we have started from our journey from 0.5 to now we have reached at a cumulative 9 months is 0.76. So in the same way, we are confident that we will continue to grow in that return on asset. It may be 1% or 5 basis points here and there by the end of the next financial year.
Appreciate your time, Mr. Raju. Thanks so much for joining in and giving us that clarity. That's the word coming in from Canara Bank, the FY23 guidance at 2.9%, and the yield on advances has gained about 21 basis points. The management saying that slippages will be less than recovery. Time for a quick break. Stay with us. On the other side, the management of Route Mobile joins in to walk us through what factors have aided the quarterly numbers. We'll have Rajdeep Gupta, who's the founder and group CEO at Route Mobile, joining in. All right, as promised, we've got Rajiv Gupta, the founder and group CEO at Route Mobile, here to talk about their quarterly numbers in greater detail. The stock is on a tear in today's trading session as well. Thank you so much for taking time out. Now, let's get straight to it, because for FY23, you had guided for a revenue growth of 60%. For 9 months, it's been an 86% growth. Were you conservative earlier, or do you think that Q4 will be muted, and are you revising the guidance?
Sorry, I'm not able to hear you very clearly.
Mr. Gupta, is my audio clear now? Can you hear me?
Yeah.
Yeah. So I was talking about your revenue guidance. You've grown 86% in 9 months, and you had guided for a revenue growth of 60%. Are you going to revise your estimates, or do you think that Q4 will be a little bit muted?
Good morning, everyone. I think guidance of 60% is still a very good number, and we really want to overachieve our guidance. And for it is very important to give a conservative guidance and overachieve. And I think, I know the numbers are already showing a great growth, but we will still stick to 60% growth guidance. But we are definitely sure that we are going to achieve more than 60% this year.
You already have, because, you know, for the last 9 months, you've already grown 86%. So one is wondering whether you were conservative earlier, or you think Q4 is going to be muted.
So I think you need to also understand the market mix. You know, like Q3 is always the best quarter for Route Mobile, and it is a trend we have seen from last so many years. And Q4 is almost like the same as what Q3 is. Based on the current run rate, I think definitely we are going to achieve over 70% for sure. And but if you want to take that as a guidance, you can take it. If as a company I want to stick to 60% plus growth, when I say 60% plus growth, it can be 75% also.
This kind of a linear trend to continue without getting into specific numbers, because we are in January 2023. Next 3 months, the next financial year will start. As we look into 2024 and beyond, do you see this kind of a strong growth momentum will sustain?
So definitely yes. I see as we speak right now, I think it's a combination of 2 acquisitions which we have done in past quarters. I think it's a combined revenue of both those 2 acquisitions as well. If you talk about financial year 23-24, probably our growth guidance is going to be definitely between 25 to 30% rate.
Sorry, I don't want to get this one wrong. You have guided for 60% and you will beat that guidance. Now what you're saying that going forward, your guidance, which is 60%, you will bring it down to 20 to 25%?
Yes, exactly, because if it's a combination of certain acquisition which we have done in last quarters, and if you take that in consideration, combined revenue of the Route Mobile is going to be about 3,400 crore. And even if I just give a guidance of over 25% on that, we are talking about over 4,000 crore revenue guidance for the next financial year.
If I look at your peers, they've reported a very different trend. I mean, I'm looking at not the absolute number, I'm looking at the relative comparison. What your peers have reported is that they've reported a weak revenue growth, but a strong volume growth. These are typical signs that there is going to be either pricing pressure or competition will intensify. Is that true? Is that the trend for the industry?
Not at all. I think as I said, Route Mobile is a global company, and we work in 20 different markets, and we are not dependent on one single market. And then competitive intensity in the market where we operate, we are in certain market we are very large as compared to other competitors. Our growth is coming not only from India, it is coming all the way from Latin America, Africa, Middle East and Asia. And I think we are very well positioned right now, closing certain deal with operators. And this particular coming financial year, we would love to focus more on operator deals for a long-term basis, so that we have a very clear guidance about our revenue in future. We are already working with multiple banks all across the globe, and we are very sure that the more number of banking customers going to be as a part of our portfolio will add more volume growth and revenue growth to us.
Okay, so that's the plan as far as high volume growth and revenue growth goes, focus on diversifying geographies as well. Now, you talked about one acquisition. What I wanted to get a sense from you, because this has been said in the past, you will also look at inorganic growth in a big strategic way. Is that still on the cards, or do you think the change in macros, especially what's happened overseas, could result in you maybe slowing down or pressing the pause button?
So right now, I think we are well focused on how to create a cross-sell, upsell opportunity within the companies which we acquired. And there are certain products which we are building in-house, and it is a very unique product we are building, which we are going to launch on 27th February in Barcelona. This is a unique product which is going to solve or mitigate the risk of digital fraud. As we speak, the number of digital transactions is increasing day by day. At the same time, digital fraud is also increasing. And it is not the problem of a country like India, but I think it's a problem of all the emerging countries who are facing right now. We are trying to build a solution where we can give some kind of insight to banks or fintech companies or wallet companies to make sure they can control this risk before it happens. And that is a product which we have built in-house. And I think in coming quarters or years, we would love to build certain products in-house. And there is two new products which is there in our pipeline, and we are very bullish about those two products which we are going to launch in coming quarters.
Okay, we'll leave it at that. That's Route Mobile for you. Today, the stock is higher by nearly 7%, reacting, of course, to the numbers that have been put out, and, of course, the strong commentary that is coming in, the bullish commentary that is also coming in from the management. Thanks a lot for your time. Right, and with that, we're going to now shift gears and talk about a stock that has given a 45% plus return in the last 1 year. I am talking about Triveni Turbine, with the top management getting set to join us. If you look at the third quarter performance, what we've actually seen is the profit rising to 52 crore rupees, total income meanwhile at 337 crores in the third quarter, up from 233 crores a year ago. So with that, I'd like to now invite Nikhil Sawhney, who's live with us. Nikhil, good morning. This is Nayantara Rai joining in from the Noida studio. I do remember that in the last quarter, you did promise a factory visit and an interview, which still hasn't happened. So let's hope in 2023 that does. Nikhil, good set of numbers that have come in, whether we look at the top line and we look at the bottom line, a strong operating performance. If we look at the corporate performance as well, it's a year that's gone by, the financial year, where we've seen succession planning with the disinvestment by Triveni Engineering in Triveni Turbines. We've seen a share buyback as well. What's next?
Well, Nayantara, firstly, thank you very much for having me on, and open invitation to come down to Bangalore whenever you may like. So please let me know about that. About Triveni Turbine, yes, we have had, from a family perspective, a degree of succession planning to just get clarity on ownership structure between the family within the two operating companies that we have, which is Triveni Turbine and Triveni Engineering. But for Triveni Turbine in specific, as you rightly point out, we've had a record quarter from all aspects, not only in terms of turnover, in terms of profitability, but also in terms of order booking. As a capital goods company which caters to the markets of industrial heat and power and renewable energy power generation, the company is on a very good footing, not only to complete this year with a better Q4 than we have had a Q3, but in fact, starting off FY24 on a very good step. And we're anticipating very good growth in the next year as well. It's important to recognize that the market in which we cater to is industrial heat and power and renewable energy power generation. And both of these actually are in an upswing. We have an installed base in over 85 countries globally. And despite the signs of global recession, we actually have had an increase in our inquiry book in the international market by over 55%. It's important to recognize that about 50% of end energy consumption is in the form of heating and cooling. And especially when you look at it from the industrial or institutional perspective, this has to be generated on site. It's very difficult for it to be, disrupted by solar or wind, because electricity as a form of generating heat is reasonably inefficient, especially as you look at it from the perspective of industry. And that is the need for us to move towards a hydrogen economy. And Triveni Turbine, with a IP portfolio in excess of 315 or 316 odd IPs that we have, unique IPs that we have registered, is very well poised to cater and capitalize on this decarbonization and energy transition mix that we're undergoing at this point in time.
How much of your order book now is legacy order book? How much of your order book now is the new order book? Because the transition is important because of the volatility in commodity prices.
Yes, Nikunj, that's a great question. Our order delivery cycle is on average about 9 months. And so what you would see at any given point in time of our order book is that would be executed within the following 12 months. And in fact, we would have book and bill within a period of 3 months as well. So our end order book, which is in excess of 1,200 crores as of the 31st of December, gives you an indication as to what we may see in the following 12 months. But you bring up an important point about commodity pricing. And while our current revenues and turnover incorporate a commodity price at the point in time that the orders were booked, which were actually higher at that point in time, we've seen those come down, and that gives us good visibility towards possible margin expansion in the quarters to come. That coupled with the fact that we have a mix, the change in our product mix. As you see, execution on the domestic market carries lower margins, and exports do have a higher margin for us. And as we've seen, international order booking has been quite resilient. And so we see that contributing more significantly towards turnover, which again is positive for margins going forward.
Get that, and I'm sure the markets as well are liking that commentary. Great to have you on the show, Nikhil. Commercial obligations, so we're going to let you go on that note, have a detailed chat perhaps a little later once the earnings season, madness is subsided a little bit. Let me quickly welcome on board Amur S. Lakshmi Narayanan, the MD and CEO at Tata Communications as well, joining in on the show. So thank you, so much for taking the time out. Firstly, to start off with, this is the second consecutive quarter of double-digit data revenue growth for you. What were the factors, would you say, that aided this kind of growth for you?
Firstly, we are sharply focused on executing on our strategy. We talked about our strategy in 2020 when we launched our new strategy of Reimagine. We talked about financial fitness. We talked about our shift to customers with deeper, with fewer. We talked about our product to platform shifts. And we are very, very focused on executing these strategies. Now, the financial fitness goals we achieved ahead of time. And the product to platform shift is still in progress. So I would attribute this growth to executing on the strategy holistically, but more particularly in the investments that we made in our products and platforms, and also the sales and marketing investments that we are making, particularly in the international markets, where we have to show and grow our share of the pie in those markets, which is a big white space for us. So these are the things that we've been doing, and we are beginning to see the results of that.
So the question is, how sustainable will this growth be going into the coming quarters?
Yes, I think what we are hearing from our customers is a good acceptance of what we are talking to them about. We find that as we talk to our customers, our relevance to them in terms of their digital transformation is ever more increasing and important. We talk about the digital fabric, which is secure and intelligent and covers all the way from connected cars to the factories to the cloud and everything else. So we offer a digital fabric that is intelligent, on top of which our customers build their applications. And this is getting great resonance. Our funnel is quite good. Our win rates are inching upwards. So all things being equal, we are very confident of keeping this growth.
So though your margins are in line with your guidance, it has also slipped on a sequential basis. There is a sudden escalation in cost, specifically on employee cost. What has led to this cost hike?
No, I wouldn't say it's one-off. As I mentioned, we are investing in talent. We are investing in our products and platform. This is very much in line with our strategy, and we are executing that strategy. We've always been saying that these costs will come. We also said that some of the benefits that we had because of the COVID, where travels were restricted, some of the marketing events could not take place. All of those are coming back. So I think the costs would come back, is what we said, and that is what is happening, and that's showing in the results of both the growth as well as the margins.
Good morning. So the question now is that if you're going to have this revenue growth, which you're saying is going to be sustainable as well, this higher revenue growth, is it also going to be backed by higher EBITDA margins? That's what the street would want to know.
We, if our ambition, as I said, is to operate in that 23 to 25% margin range. We had seen some headwinds, as I said. Besides our investment, there were headwinds with respect to inflationary pressures, both on the wage inflation as well as the inflationary pressures on other OPEX-related costs. So those would be there. I would think that these are temporary, but as we grow, clearly the EBITDAs would also grow.
So how does the sales funnel and order book look like for this quarter? How much has the growth been, and what is your order pipeline looking like?
The pipeline is quite strong. The funnel is strong. We are also improving our win rates, particularly on large deals. The number of large deals, in our definition, it's more a annual contract value of more than $1 million. Those kind of deals are increasing the pipeline, and number of deals that we have signed up was also increased over the last year. So I think the funnel is quite strong. And as I said, what gives more encouragement to me is the kind of conversations we're able to have with our customers. And it's resonating because our portfolio today addresses not just the cost side of the equation of our customers, but it's resonating with the revenue side in terms of how can we impact their customer experience through our products like DIGO. How can we impact their connected solutions, which is a driver for improving their efficiency as well as finding new sources of revenues for them. So I think the resonance is increasing, our relevance is increasing to them. So we are quite confident of keeping up the momentum in our funnel.
You know, the Switch acquisition that you announced in December, this was the first inorganic growth for your company. How much will this acquisition add to your top line and EBITDA?
This acquisition is very strategic for us. We have said that with the strengthening of our balance sheet, now it opens up many optionalities for us to find ways to invest. And this is one and first such instance where it's entirely funded through the cash generated within the company. We will make acquisitions when it helps us to extend our product line, extend our reach to customers. So what Switch does to us is it's one of the market leaders in the US for the sporting events. Now, Tata Communications, our media segment has been very strong with global sporting federations like the Formula Ones and the Formula E and others. And these global sporting federations reaching global audience. So what we call as a global to global segment. Switch specializes in a lot of US regional events, distributing it regionally. Now we
Mr. Lakshmi Narayanan, great to have you today on ET Now. Thank you so much for taking the time out and speaking with us. We'll take a very quick break on that note. When we come back, full tilt on what to expect from the budget this time.